All right, good afternoon, everyone. I'm Dan Benkin with UNI's Advanced Iowa program, and we are joined today by two Panther grads, which I'm really excited. The first time ever we've had two Panthers as part of our Wednesday webinar. And we'll be talking with Todd Somerfeld, who's currently the executive president of Kreg Tool up in Huxley, and soon to be moving and relocating to Ankeny in the next few years, I know. And maybe you've seen their products on the shelves in your local Home Depot, Menards type place. I know I use their pocket hole jig all the time. And Greg Weber is with us as well, UNI grad and CPA, both accountants, I assume. Right? Are you CPA too, Todd?
I am.
All right, great. All right. So if you got tax questions, we can cover those too.
I'm a little out of practice.
Okay, that's fair. That's fair. I won't put you on the spot.
And I never claim to be a tax person.
Okay, fair enough.
So I won't take any tax questions.
All right. So Greg is a partner here at BCC Advisors, and a lot of their work is focused on evaluation, valuation of firms, and helping them through the exit planning process, and more specifically, ESOPs, employee stock ownership plans, and that's what we're going to be talking about today is ESOPs. And so you came to hear from them, not from me, and so I'm going to turn it over to Greg, allow him to introduce himself and his background a little bit more, and we'll go from there.
Sounds great. So again, Greg Weber. I have I've been practicing in accounting. I was practicing in accounting and have been doing appraisals of businesses for 20 years. Much of my practice revolves around ESOP, and frequently talk with business owners that are considering an ESOP, what the possibilities are, what the ramifications are. Perfect. So
Yeah, let's get into it. You got problems?
yeah, the slide isn't the slide advance.
Technical.
I'll jump into the next slide while we're advancing. So a little background on ESOPs. An ESOP, thanks, Dan.
Yeah.
An ESOP is like a 401k, but the difference is that the ESOP can purchase the stock of the sponsoring company using debt to fund the acquisition. An ESOP trust actually owns the securities, and a trustee is required. We'll talk more about the trustees in a minute. And ESOPs can own between really any percentage of the business, 0 to 100%. So we'll get into the ramifications of a large or a small block a little later. So why do business owners establish an ESOP? Why do they sell shares or their entire business to an ESOP? There's several kind of key reasons we see. One is to preserve jobs in their community. In some of the smaller communities, this can be the primary reason. We have a large number of community banks in Iowa, and many of them are owned partially by an ESOP. That helps solidify that employment base in their community, and can be a real key to some of the economic problems that we have in rural Iowa and around the country. The largest reason we're seeing more recently is to improve employee recruitment and retention. Unemployment rates are especially low right now. We're seeing a large number of new ESOPs being established with construction contractors, subs, primarily, but also looking at some generals, and that retention of that employee base, especially as it's not growing to meet the demand that we have, is going to create, really, we think, some significant advantage for the employers that are adopting the ESOP. And then another one is to reward the key management or the employees that helped build the company. And we see these there's financial ramifications. We'll talk about that in a minute. But we see these as kind of the three other reasons beyond just simple transition. And Todd, I'm curious how you felt your transition fit into this.
Yeah, well, for us, we were looking at both the cultural aspects of the ESOP. Had been practicing open book management for about 6 years prior to becoming an ESOP, and we were going through ownership transition. So we'd been business or estate planning and business succession planning. So our business is, I'm second generation owner. So I currently own 80% of our business, 20% is owned by our ESOP. And the way I got to 80% was I came into the business in 1999 out of UNI. Thank you, Dan. Spent 7 months in public accounting, joined a company, a little company at the time, had about 12 employees. And I owned about 30% of the company at that point. My sister owned 30% of the company. My parents owned a minority, actually. And so that changed over time. We had different operating companies and an IP company, and I got more of the value from an IP company. In 2006, we bought out my sister's shares because she's not involved in the business. All that fast forwarded to 2015, where we were looking at my parents buying them out. And so when we were looking at that, it was a matter of, well, do I buy the remaining 20% from them? Do we look at private equity? You know, we looked at all different options from a way to go with ownership and equity transaction. For us, it was a combination of an ESOP culture is one that we were trying to create with open book management. As the business was growing, we were at about 200 employees, over 200 employees at the time that we launched our ESOP in 2015, and really trying to create that culture. So there's that aspect of it, and then there's the aspect of the sellers. My mom and dad, who were selling their shares, and they liked the idea of the ESOP as well, because that's if I wasn't buying it, the next best thing I think in their mind is that the employees that are there would be vested in that. And so we can get into other aspects of it, but that's really twofold from our standpoint. Some of the reasons why we chose the ESOP route from their standpoint, and then obviously it's has to do with my long-term planning and estate planning, and we can maybe get more into that down the road. But that's a highlight how we got into it.
Good.
I'm getting one question from the audience about open book. Todd, would you mind at a high level describing that and why you're using it, or why you decided to go that route?
Yeah, so in 2009, I read a book called The Great Game of Business by Jack Stack. And it was an ESOP company down in Springfield, Missouri. I really liked the aspect. So having an accounting finance degree, I make a lot of decisions based on long-term value growth. It seems natural to me. And I was amazed at how people made decisions that were not in the best financial interest of the business. And so one of the tools that I looked at, well, let me show you the books and use it as a way to teach people the finances of a business, so that I'm not dictating decisions, that those decisions are come about by the players of the game, so the employees of the business. And so it's a philosophy that I've applied that. So I applied the Great Game of Business open book management philosophy. And we had bonuses based on profits. We took away bonuses based on siloed sales goals and cost improvement goals, and made it on profit. But the idea of the ESOP is you have a stake in the outcome of the game. So it's another incentive that goes along with open book practices. So that's
Perfect. Thanks.
just the high level.
Great. So as Todd said, and there's the sale involved a a minority interest in the business. The owners can sell any range of ownership from a small stake to 100%. When we think of the situations where people sell a minority interest, sometimes what they're looking at is creating a market. We see on occasion a small group of owners, maybe they're unrelated, 3, 5, 8, and people, and one of them is nearing retirement perhaps, and they look to create an ESOP, buys the shares from that partner, that owner, and they then, as an ESOP owning that minority interest, can be another buyer for shares over time. So it creates a little bit of a market. That's a benefit to all the shareholders. And then the sellers can get returns, after-tax returns over time, that are similar to what a third-party buyer would pay. And there's a lot more detail we can go into on synergistic buyer and the fair market value standard, but that's more technical. So I'll avoid that unless that's a major question. So the seller receives generally some payment at closing of the ESOP transaction, and then receives returns, the remainder of their returns, on a note with interest and principal payments over time. In some transactions, primarily where there's 100% interest being acquired, you can also use warrants that provide some capital appreciation to the seller while that note is outstanding. So that's the benefits to the shareholders that are selling. What benefits the employees receive are pretty profound. They get a larger retirement benefit, and that's 5 words, but for most of them that is an incredibly important characteristic. They're receiving much more than they would ever get absent the ESOP being in place. They're getting a retirement contribution that is larger perhaps than what they would get with a typical IRA, 401k kind of structure. And within their account, the company is appreciating many times faster than what the market does. So they are, with the ESOP in place, able to get an interest in a business without a personal guarantee that they could never get if they tried to buy the shares with a bank loan. Most employees just couldn't acquire shares in the business without the ESOP as the vehicle. So that's an incredible benefit. Preserving the culture and the jobs in their company and in their community is important, but just to clarify, that isn't a guarantee of employment. So there's nothing there that says that any particular employee who is an owner is that the company is stuck with them if they're not performing.
So bad apples can still get tossed out.
Exactly.
Do they leave with their shares of the company, or do they?
The ESOP plan document defines what happens.
Okay.
But the vast majority of the ones that we see, when somebody departs as a participant, their shares have to be bought out.
Okay.
And that repurchase, and that comes up a little bit in a couple of slides, but that repurchase is a function again of the plan document, but it can be either all of the amount due at once, or it can be paid out over 5 years. Okay. Generally speaking.
Okay. Thanks.
So the other benefit is it rewards the long-term employees. The benefit accrues to the employees over time as the loan is repaid using the retirement contributions that the company makes. So those employees who stay the longest get the most benefit. As Dan alluded to, if one employee leaves earlier, then their benefit is limited. So this is not a get-rich-quick kind of a scheme. I think it's important to note that the individual employees who are participants in the ESOP don't vote on shareholder matters, which means it's much more efficient as a corporate structure compared to having a large number of minority shareholders. It's always more efficient to just have one shareholder, but if you're going to have a structure where you're going to have multiple, having an ESOP in place can make some of that more efficient.
Along with that, maybe Greg, are the shareholders still, are the individual employees still very much all aware of the P&L, the financial operation of the business they are? I'm
So
assuming?
it depends on how open book the company is. Todd's company shares more than some of my other clients do. I have some that do similar, but some of them will just share the share value, provide the share value at the end of the year and say that's it.
Okay.
I think that's a little short-sighted. There needs to be some additional communication to really get the motivation of the employees.
Sure.
So it might be that you boil it down to what's important to that employee to really get them to engage in it. So it might be how quickly they can produce that product, or how carefully they produce that product, right? So you don't have defaults. It might be revenue levels. So you might just report revenues over time, or you could go all the way and provide financials. It just varies.
Okay, thanks.
But it's really important, and I think the nugget that I get out of your question too is it's really important to make sure you get employee engagement by providing them some way to connect what they do to the financial performance of the business and then to the share value.
Sure. Okay, thanks.
So studies show that you can get better employee motivation and performance with an ESOP in place. And that's one of the biggest benefits to the company that sponsors the ESOP. You can still, in some cases, preserve the culture within the company when the company stays local, owned by the ESOP, rather than being a company sold to another buyer, perhaps out of state, that doesn't have the same connection to the community.
Todd, do you have any anecdotal evidence of that, or have you seen that with your firm as far as, flipping that switch a little bit? Have you noticed anything?
Well, for us, we look at the ESOP as if we're going to change the ownership structure, that's going to keep the business local. We sell all across the country. We sell through Lowe's and Home Depot. If we were to sell to private equity, eventually that private equity firm would sell to a bigger private equity firm, and that ownership structure may be based elsewhere, and you can run this business. It doesn't have to be run out of Iowa from any geographical reasons. Some of the larger players in our industry, which would look to acquire a smaller company like us, would not likely keep the jobs in Iowa. They may for a while, but eventually they're going to consolidate and they're going to move that. And so there's absolutely a component of if you keep the ownership local, the jobs will stay local, which is why federal and tax laws are favorable to ESOPs, because they do retain jobs.
Sure. Okay.
So there's local retention, and then there's the retentional aspect of employees stay from a long-term perspective.
Okay.
So yeah, we'll go through that some of that.
Thanks.
Yeah. So from a purely financial aspect, the benefit to the sponsoring company, if the company is a C corporation, they can deduct the principal and the interest on the acquisition debt because it's a retirement contribution. Whereas if the acquisition was made by a company that is not an ESOP, then only the interest could be deducted. The benefit to an S corporation, and especially an S corporation 100% owned by the ESOP, is that instead of making tax distributions to the shareholders to cover their personal tax liability associated with ownership of the business, the company can keep that fund in the business. And for example, that might be 30 to 40% of pre-tax income that would normally be distributed is instead retained. And that 30 to 40% then can be used paying down the debt. That's generally what happens in the early years, funding growth, redeeming shares in the later years, reinvesting in the business, equipment, facilities, and buying other businesses. And we see our clients that have been 100% for a while doing all versions of that. It's a fantastic growth vehicle, and but it does require the foresight of the owners, the selling shareholders, to say, we're going to give up our 100% stake in the business to get this benefit. So those are the benefits. What are the other impacts on the sponsoring company? The ESOP requires an annual valuation and participant accounting and compliance testing. So think about this in the context of your 401k. You have to provide the statement to all the employees every year. So to provide that statement for the ESOP participants every year, you need to hire the plan administrator that helps do the accounting and record keeping, and you need to hire, or the trustee hires, an appraiser to do the valuation every year. So the company then has to pay the costs for all those annual services, plus there's also the transactional cost up front. And I'm sure if I don't say some idea of what those costs might be, there will be a question about it. And it varies significantly by what level of service you're looking for, how complex your business is, how complex of a transaction is needed. The lowest level of transaction costs might be $100,000, and easily can go up from there. The annual costs is harder to estimate because it depends a lot on what mix of services you need, but it's still, could easily be $40,000 or $30,000, and is very likely to be much more, depending. And I'll get into some of the aspects in which it depends in a little bit. So the ESOP requires monitoring of the repurchase obligation, and I think that needs some definition. So as we talked earlier, as a participant leaves, the plan is required to redeem their shares. Might be all at once, might be over a 5-year period, but it is crucial that the plan have advisors that do repurchase obligation studies every few years to track and predict the cash flows that will be needed for that. And that is an appreciable effort. And really what we see is that is one of the reasons that ESOPs can fail. And when I say fail, ultimately, if that isn't monitored, then the obligation builds up. You have a group of people that retire in short proximity, and there's not enough money to fund it. And the company has to be sold to a third-party buyer, which is what the owners perhaps were trying to avoid in the first place. So our experience has not let that happen. Our clients have not experienced that. But I do hear stories that does happen.
Okay, I got one question on that quick
Sure.
from the audience, Greg, as far as a lot of companies have older workforces in Iowa, or they maybe have a concentration of folks, kind of paraphrasing, but they have 55 plus type employees. And can you strategically or otherwise work around that issue to go through an ESOP?
Well, you still haven't, if the workforce is older, the company still has an issue.
Sure.
And an ESOP won't necessarily solve that issue. It may help recruit some more people, but the company's going to have to be willing to build up that workforce, maybe at a cost that is more than what they're used to, because they're going to have to hire young people at the same time that they have the older people, the long-term employees,
Mm-hmm.
and they're going to have some duplication. So an ESOP won't completely solve that issue.
Okay.
And if one sells that company where the average age is 55, then there will be a difficulty down the road. The repurchase obligation can be deferred as long as the loan is outstanding, but that doesn't solve the problem.
Okay.
So another important impact on the sponsor company is immediately after the transaction, the equity value of the company decreases by the debt. So the debt is incurred by the ESOP, between the ESOP and the sellers, but it's guaranteed by the company. So as an example of this, if you bought your house, and you can't do this, but if you could entirely fund the house purchase with a mortgage, then you buy the house and it's a $500,000 house, and the mortgage is a $500,000 mortgage. Well, your house is still worth $500,000. Your equity in the house, though, is only zero because it's entirely offset by the debt. The same thing happens with an ESOP company. So you have a $10 million business, and the business immediately after the ESOP would show the same balance sheet as it had before, except it would have this $10 million guaranteed debt that would show up, that would reduce the equity, reduce the capitalization. And so the company is much more highly leveraged. So if you have a banking relationship with covenants, this can impact your covenant compliance. And so you need to make sure your bank is on board. Another place this can affect is insurance coverage. Sometimes for, say, contractors that would have their insurance, that they'd have to submit information and have a certain level of capital, and this could cause them to be out of compliance. We don't find that becomes a problem. The banks and the insurance companies can be talked through this so that they understand, or you need to work with one that does, because there are ones that do.
So let me give an example to just highlight this in our case. So in our case, we were selling, you can sell, as Greg said, a portion up to 100% of the company to the ESOP. We sold about 20%. And we did that by borrowing money from a bank. So it's a leveraged ESOP. So we borrowed the money on a 6-year loan.
Meaning the majority shareholders bought.
So 20% of the value was borrowed, and it was at that time paid in cash to my parents. So they got the value of 20%. The company then is paying that back to the bank over 6 years. The employees get 1/10 of that. So we stretched that 20% out, and we said, okay, we're gonna distribute that to the employees over 10 years. There's an external loan, 6 years, internal loan is 10 years. So 1/10 of what we purchased goes out. And let's say this is $10 million, it's a little more than this, but say it's a $10 million valuation. We have $2 million that we bought, loan to the bank, and so $200,000 goes every year as a contribution in shares. Well, then those shares are going up. So it went from 200,000 to 220, right? So that amount is going out, but it's based on number of shares, for same number of shares for the next 10 years. And if you buy more, so a lot of the companies that we researched, some of them were 100%, their loan isn't, so you're not transferring all of the company immediately. You do it over a period of time. The more you buy the different amounts, the longer that internal loan could be. In some cases, 35 years, right? So the employees don't get all of the equity right away. And so for us, over a 10-year period, that amounts to about 12 to 15% contribution. So if you make $100,000 a year, you're getting 12 to 15,000 in stock value per year, is that's the benefit amount in our case. And so that will go on for about another 5 years now, and then we're out of shares. And so that's where, in our case, we will do another round. I will sell more shares so that the ESOP has, and we'll at that time determine of that chunk of shares, how long do we want to set that loan? And right now, that could be up to 20 years. based on share company growth and all of that. So it's just to put an example to what you're saying there, Greg. That's why even if you have an older workforce, you're not giving them all of the equity at that time. They would get a portion of it, but depending on how long you stretch that out, you're giving that benefit to new people you're hiring as much as the existing population.
Yeah, and that really is a great example. And different companies do the nuances of that differently, but the core nugget I think that's really important too to take out of that is that you don't want to have a situation where all the shares go out and you don't have a way to get more shares to the employees over time. And Todd's company has a plan to address that, and others, as he alluded to, might, if they do a 100% transaction, might stretch that over 20, 25, 30 years, so that it goes through a whole nother generation of employees that will be owners over time.
Okay.
So it's also important to recognize that the trustees of the ESOP will require either audited or reviewed financials. So if you don't have those already, and you're thinking about going down the ESOP route, plan to get them and recognize that you will get them before the last minute, so that it doesn't become a problem that holds up the transaction. So if you like the benefits that we've talked about and the costs don't scare you away, then we'll talk a little bit about the steps to establish an ESOP. So first of all, you need to develop your goals. What is it you're trying to accomplish? How much do you want to get to the ESOP? Are you looking to get to 100% over either immediately or a long period of time? And when? Do you want to just start it with a certain minority block, say 20%, 10%, 30, whatever it might be, and that's what it will be, and for the foreseeable future? And what's your time frame to make this happen? Think through that. Your transitioning your management duties, I think, is really crucial to think about. Doesn't mean you have to do it right away. If I have some of our ESOPs that have sold 100% all at once, have been sold by relatively young owners who are not nearing retirement. So they will continue to run the business for 20 or 30 years. So there's no transitioning that they will do in the near term. But if you're approaching retirement age, then you need to have already started transitioning management duties. I'll tell you, that is probably one of the biggest hurdles, and we'll get to some of these later, but one of the biggest hurdles to setting up an ESOP is not having a management team in place that's ready to run the business. If you have that in place, then you've got a leg up and you're already down the road. If you don't, then you need to start setting up the structures to make that possible.
Greg, could you talk a little bit about why a younger owner might want to do an ESOP and stick around, or why you've seen that done in the past? And Todd, obviously you're younger, and maybe you want to talk as well about, how you came to decide to do this as well. Does that make sense?
Yeah, I'd be happy to jump into it. But and a couple of this we'll touch on later, but I'm going to go ahead and go into it now. One situation is where the owner felt like the employees had helped him grow the business to much more than he ever thought he would have. And he just wanted to reward them, but also retain them to make sure that the business continued on. So he sold 100% and has no plans to leave. But it's a joint effort then, a joint ownership, rewarding them and future employees. And he's in a business that he's a contractor, and it's hard to get contractors. We all hear that story. Sure. Another one I can think of wanted. That was part of the reason for the second one, the second example here. But the larger reason for them is that and again, they're contractors in a different aspect of construction, and their concern was that their employees wear out. Their bodies wear out by their 50s. And so there's a whole group of their employees that can't work to 65 or 70 or whatever the retirement age might be, like the average office worker could, for example. So they wanted to enable those employees to have a retirement account in their 50s that would enable them to retire or change jobs to maybe something that doesn't pay as much as their construction job had. And so those guys, they didn't do it to retire. They're not going to retire anytime soon. They love what they're doing, but they want that business to support the employees.
Sure. Cool. Thanks.
So for my case, it's as we talk, it's very layered. So there was what I wanted for my parents, what I wanted for the company, and then what I want for myself. And so in my situation, I had started transitioning day-to-day operations of the business over to an non-family member, and realizing that I like to start things. I like to grow things. I started to see myself as if the risks I wanted to take when I was 23 are different than I was 33 and I'm 43. And it just, I wanted to continue to grow and move. And ultimately, I see myself doing other things besides Kreg Tool Company in my life. And so for me, this gives me a way to maintain the company, but it helps me psychologically let go and move into other things. And it's the way we've set it up is like, I can start to move into those things. I'm not moving into that now. I have a period of time that I can plan that. I don't know exactly what I'm doing, but it helps me stay connected to the business and oversee it. And my title is chairman. I'm not the president or CEO any longer. Those duties are established by someone else. I oversee that, but I'm for me, I'm looking at selling the portion of the business and going and doing other things. Well, what about your family? Don't you want? I want my family and my kids. I have 3 kids. I see us taking equity from this family business and creating other family businesses. I don't know exactly what that looks like, but that's part of who I am, part of what I want to do, and this helps me do that. That's not, everybody's not going to fit into that same category. Sure. That's how I view it.
Perfect. Thanks, Todd.
That's great. So another consideration in the planning is when the owner wants to receive their proceeds. And if the owner wants their 100% of their proceeds on closing, then an ESOP is most likely not going to work, and they just need to perhaps sell to a third party. An ESOP can provide, if an owner sells 100% all at once, the ESOP can provide some liquidity at closing, especially if a bank gets involved and funds part of it. But most of the transactions we work on are funded over time on seller financing. And the sellers can get a nice interest rate and hold the risk in the company that they know, rather than reinvesting in maybe in a stock market that they don't know as well.
What's a common, down payment, so to speak, that the current owner might walk away with in a 100% transaction? I have some that will ask, like if a company has excess cash, maybe they'll take that out. And there's some ways to be creative around it. But for the most part, if they're going 100%, they probably won't get very much. They will choose not to take very much. It's not that they couldn't get it, because they can. But they're not doing it because they need the money. Okay.
They're doing it because it's part of the overall transition plan. And they'll take, they'll get paid maybe over a 10-year period.
Okay.
For example. So the loan payments would stretch out over 10 years.
So the bank note might be 30 years, but their terms
Well,
to get paid off in full, we're closer to.
theirs might be 10 years.
Okay.
The 30-year loan that Todd was alluding to, and I was a little bit earlier, is more the loan between the company and the ESOP
Okay.
that defines the rate at which shares are released to the employees.
Okay.
There's no bank involved in that aspect of it.
Thanks.
So some alternatives to think about. The first is to sell a block of shares in a transaction, and that block, again, could be 0 to 100%. Practically speaking, too small of a block doesn't make sense from the cost standpoint. But as you think about doing a transaction, it creates liquidity for the shareholder. And we just kind of talked about some aspects of that. A larger transaction gets a larger block of shares available to the employees. So they are locking in more. If Todd had said that his was only going to be the first 20% and then stop, then that would be a lesser opportunity. But he's made a commitment, at least a personal commitment, to make more shares available when needed. So in his situation, he's created this larger opportunity for the employees. The transaction approach that we're talking about requires more professional service costs. As an alternative to that, okay, transactions, one can decide just to contribute shares to an ESOP. So you might say, we're going to, in using Todd's example, we're going to make a benefit of 12 to 15% available to the employees. And instead of doing a transaction where there's a large block of shares purchased, we're just going to contribute. We're going to do the math, figure out what 12% of payroll is, and we're going to contribute shares worth that amount to the ESOP. So that allows an ESOP to start smaller. They don't have to do a loan. You don't have quite as much professional service costs, but it is a lesser opportunity initially. Many times what I see is that this methodology works where an owner wants to dip their toe in the idea. And so they start and they contribute, and it ends up being, a couple percent maybe of the company, 1.5%, 2%, 3%, for a year or 2 or 3. And then they say, yeah, this is working how we thought. Now we're all in. And then they'll do, a large transaction. We've done it a couple where it's 100% all in, and they do it. So that's the way the alternative could be there, right? So again, to restate that, you could do transaction where the ESOP buys a block of shares, and if you do that, you have to hire a trustee. We're getting into that next, but you have to hire a trustee to represent the ESOP and the employees so that the owner isn't negotiating against themselves. As the alternative, you contribute shares. There's no choice to buy shares or negotiation or price. So one could then maybe choose whether to have it be an internal trustee or an external trustee. And again, I'll get into that in a second. All right, so here we are, trustees. The range, generally speaking, the way I talk to people about the range of trustees that we see. First, there's either an independent trustee or an internal trustee. And an internal might be somebody from the company. Might be the owner, might be the CFO, COO, executive team, whatever. But somebody within the company that acts as the trustee. An independent trustee is somebody that's hired by the ESOP, by the board, to represent the ESOP as trustee. And that could be an institutional or it could be an individual. And the institutional really means, say, a bank trust department takes on that role. And individual is somebody whose job really is just being a trustee for ESOPs. And I emphasize here that if you're going to go down this road and you're going to hire an independent trustee, you should make sure they have significant ESOP experience. There's been plenty of litigation. The Department of Labor really gets involved if they don't see that the proper procedures are followed. And it's crucial that you have a good trustee to help you through the process. The times that we see an internal involved is not when there's a transaction. So if a company has been an ESOP for a long time, they might be internally or independently trustee. It could be either one. But if there's ever going to be, if there is a transaction imminent, then we absolutely strongly recommend that there be an independent trustee involved. It does carry an extra cost. That's where I talked earlier about the cost differences. But many people look at it as an outsourcing decision, kind of outsourcing a skill base they don't have, and shifting maybe a risk that they don't want. Did you have any consideration on that, Todd?
So we hired a trustee for the transaction, and we maintain that trustee throughout year over year. So we don't have to, especially at a 20% ESOP. It's not as it's the fiduciary responsibility isn't as high as if you were, say, 100% ESOP. But we from a governance standpoint, we have a trustee, we have a plan administrator. These are all third parties. They add to the expense, but in our view, they ensure that we are doing things at a high level, and they do help with process. We also didn't have a board, an external board beforehand. The board was all the shareholders. So the board for the last 20 years has been myself and my parents. Beginning in 2015, we created a board that was myself, our present CEO, one other internal executive, and then we have looking to have 4 now external directors, which we wouldn't have to have, and we don't have to have for the ESOP, but you do have to train them on ESOP governance because they hold fiduciary responsibility, and that having a trustee gives that extra confidence to our external board that we are doing things. There's only one of those board members has ESOP experience. So those are, and that's a 201 class in terms of all the aspects of it. But those are some of the costs that you were mentioning earlier that you maintain. We never did a full-blown audit prior to being an ESOP. We now do that. We have annual valuation expense, the annual trustee expense. But all those we think are outweighed by the growth that we're seeing in the company through the tool of the ESOP itself.
So from that standpoint, you have seen where maybe employee buy-in, engagement, productivity has gone up as a result of them becoming ownership type of thing. They're on the same side of the table as you.
That's been one of the fun aspects of rolling the ESOP out is when you're trying to get people engaged with finances in the game, right? But then you give them, really? I had not only shares, but my shares last year went up. And so it's a drip thing. It takes time for that culture to engage, but now they're talking about it, and it's real value that people get on their annual statements and they see, and it's created better, healthier discussions around decisions for the long term. And that's really one of the reasons an ESOP was good for us is we want a long-term approach. We could do a lot of things that make the business grow quicker, more profitable in the short term. But when we want to make decisions for the long term, there's some short-term sacrifices we have to give. And so an ESOP is just another way that we can encourage long-term thinking. And it's working. It's been fun. That's been a fun aspect is the cultural, people are more interested in the numbers now because they have a stake in the game. So it works.
I got another question related to that came through is on retention have you seen anything with retention, anecdotally or otherwise, where that's improved? Or
Yeah, so we're at 2018, so 2015 was our first year, and so we believe, and the numbers would prove that out, that people are staying. Now we're still in a tight workforce, and so all my peers, turnover is higher because unemployment's low and people are moving. But people have something to give up if they jump and they leave. It's not just, did my pay go up $1? It's, I no longer get this. Most 401k plans, even if they're matching, don't come anywhere close to this benefit.
Right.
But it's something that people have to understand, and we believe that over time that understanding will grow and grow, and it'll be a strategic advantage. We feel from an employment standpoint that this is one of the things you get.
Okay.
But it's still amazing to me the disconnect people have with retirement planning and what this means. So there's if you have an ESOP, I strongly encourage you to have a teaching mindset. Is use it to teach and grow. Because if you don't, then you're missing a lot of the benefit. You have to communicate. You have to get people involved to leverage, in my opinion, the power of an ESOP.
Okay.
So our CFO loves to teach people about finances. Sometimes we laugh
Bless
about
his
it.
heart. Okay.
But we want that as part of the culture, and that's how we feel that we leverage that. And that's what I'm getting to. All those other costs, when you retain people and that builds over time, we feel that those benefits, long-term benefits, outweigh the short-term costs.
Okay.
And I had a client I met with last week who is all about the retention. That's what they needed, and it's crucial to their business. And they have tracked it. They've been an ESOP for maybe 4 or 5 years. They've tracked it over time as it's every month they check their retention percentages, and there is an improvement.
Oh, cool.
You can definitely see the line on the bar chart or the line graph go up as far as the retention being better.
Sure.
So it's fantastic to see.
Okay.
But they work it, much like Todd's saying that he does. So we talked a little bit about the rest of the team. The plan administrator I've alluded to does participant statements, helps with the repurchase obligation study. The attorney generally sets up the plan documents, may not be as involved annually, but periodically. And the appraiser is hired by the trustee as the financial advisor to help them understand the value. And so they do work every year. So when is an ESOP a good fit? When management team is in place. That is crucial. We've had conversations with people, management is not in place. It's really a non-starter. The owner wants to provide an incentive and increase productivity. The owner wants to provide a legacy, either to the employees or the community or both, and local ownership. More specifically, service-related businesses are very good. In part, it is contingent on the relationship between the size of the wage base and the value of the business. And so service-related businesses, contractors tend to have a good relationship there. If you have, and I say other industries are also common, but they take more planning because you have more value relative to maybe the wage base. And keeping in mind here that the reason for that is that the wage base is what is causing the repayment of the debt. So as Todd said, they make 12 to 15% contribution. 12 to 15% of eligible wages is the contribution. That is what is repaying the loan. So if that wage base is too small relative to the size of an extremely valuable business, then it's more difficult. And that doesn't mean it's impossible. It just means you may not be able to go 100% all at once. You might do it more like Todd's doing it in phases. Yeah, you know, that's probably, I would hazard a guess, part of what got Todd to where he did as
Yeah, well, so if you win 100%, the most you can give any given year is 25% of payroll, correct? Right. So that's going to dictate how long you stretch things out. So ours is 12 to 15, but it can go up to 25.
It can go up to 25. Exactly.
And so we could have done a 5-year plan and give them a steeper benefit. We just chose to stretch that out a little longer, and that's where when we get to 5 years from now, we buy another round from me. We'll determine, and things will change. It's not 11, 12, and 15% plugging in, because part of it's how many employees are in the plan. It's what is the value doing, and there's a lot of factors to it. But you make a educated guess and plug it in that way.
Makes sense. So when is an ESOP not appropriate? Capital-intensive businesses, for the very reason we just talked about. If the relationship between value and payroll wage base is not aligned in a way that makes it work as well. Startup and early stage businesses don't work. There's too much risk there for the trustee to take on with a startup or an early stage business, that we just don't see those. In companies that vary significantly in profitability from year to year, again, it makes it hard to cash flow the loan payments if your profitability doesn't, if you have no profitability 1 year. Doesn't mean it can't be done. It just has to be more conservative when you're setting it up and managing it. Businesses that are too small, part of the characteristic there is if you have less than about 20 people, there's more risk of failing the 409P testing, which is absolutely horrible outcome. You just can't have that. So that's a practical limit. But really, to me, more important is the fact that as businesses are smaller, that key person risk is greater. So if the company loses that key person, and if it's a large company, they probably have other people ready that could step up, and everybody, up and down the organization kind of fills in and goes on. In a small company, it could cause the company to just go out of business. And that's just too much risk for an ESOP. Sometimes it can be done with, key person insurance to cover some of that, and those I do see in transactions occasionally. But it's just a practical attribute that has to be addressed, and the trustee is going to be less comfortable with it if that risk is greater. So we've seen a lot of ESOPs established over the last 5 years in Iowa, in other states. But part of what I wanted to address here is that Iowa does support establishing ESOPs really in two ways, particularly that would be paying up 50% of the cost, up to $25,000, to evaluate an ESOP, and they will reimburse the $25,000 even if the ESOP is not established, which helps an owner maybe that's looking at the cost to explore it. And the second is that 50% of the capital gain from the sale of an Iowa company to an ESOP can be excluded from income if the ESOP owns at least 30% of the company. And I said I don't give tax advice. That wasn't tax advice. So that was just a statement about it. But it's a nice little extra. Probably doesn't make one say yes or no to ESOP, but it's a nice little extra in the total picture that one is looking at.
Can you both, I know we're at 1 o'clock, and so we typically wrap up at 1 unless we have further questions and conversation. And I do have a couple extra questions from the audience. And so if anyone would like to stick around, we appreciate that. And if you have questions, to keep those coming in. The question that I've got right now, Greg and Todd, is on that tax side and the tax advantages of an ESOP. And they're asking about, do those advantages often will they outweigh or compensate for maybe the additional fee structures that are involved? And do you ever look at it that way, or do you ever sell it that way, or do you ever think about it that way?
I think that they certainly do. At the simplest level, you could say if a business is making pre-tax $1 million and it would have had to pay 30% in taxes to the government, and if they sell 100% of the business to the ESOP, then they don't have to pay the 30%. So that's 300,000. 30% of $1 million is 300,000 of tax savings each and every year. And that's kind of the most extreme example, even for a modest-sized company, that really shows how easy it is to more than justify the cost in a cost-benefit analysis.
Okay.
It's a little different if you're not 100%, because if you're at 20% and you're an S corp or a C, you're still making the tax payment. So the benefit there as a trade-off is more, and Todd can address it, but it's more about the employee benefit, productivity gains, and building a shareholder liquidity base, in my experience.
Right. So practically, the ESOP, in an S corp ESOP, you don't pay income tax at the federal or state level. So 20% of our business is tax free. I still pay taxes, so I get a distribution for 80% of the taxes. The ESOP gets 20% distribution, but it just doesn't go to pay taxes. But those are used for repurchase liability. There's certain things that cash can be used for, and so there's definitely tax advantages, and it's one of the reasons that we are an ESOP, because the tax advantages helps it fund itself essentially.
Okay, great. I got one more question about size. You mentioned 20 employees. What are some of the smaller firms that you've seen that have made that work? I mean, have you seen a firm as small as 20 employees actually work with an ESOP? Or is that...
I have,
okay.
But you have to monitor it. One of the ones that was about that small had some turnover in their key positions, and the owner actually stepped back in. The seller had sold 100%, and the key person left. So the selling owner had to step back in and make sure that the transition to the next person went right and that they got back on track. That's not a good situation. It worked out fine, but that's not what you want, and that's why trustees would view that with concern.
Okay. And I got one final question, not exactly related to ESOPs, but Todd, they're asking about that book that you mentioned earlier. Could you just reiterate that, and maybe I'll make sure that gets...
It's called The Great Game of Business by Jack Stack.
Okay, cool. Thank you. Thank you to everybody who joined us today. We're going to do this again next month. I don't have a date in front of me, unfortunately, but we'll try to get a reminder out to everybody. Next month, we'll be talking about what is a buyer looking for when they come to buy your business. What kinds of things do you need in place, like both Todd and Greg have mentioned today, a great management team and things like that. And what are the other characteristics involved? What are the things that you need to be thinking about as you make your exit planning decisions? So we'll hear firsthand from a fairly active buyer group, a private equity group. And so we appreciate all your time today. Hopefully that gave you a little more knowledge and awareness on ESOPs. Greg, Todd, thank you so much for your time as well. And with that, we'll close it up. So thank you.
All right.
Thanks,
great.
everybody.
Thank you.